So now that we understand a little bit more about venture capital and where it falls in the range of investing, can you go back to Latin America? And you mentioned your interest in 2005 about how it seemed low compared to the United States, and tell us a little bit more about what you're finding in some countries.
Well, there had already been some research on emerging market economies about like the total amount of capital inflows and outflows and so forth. But there hadn't really been any research that was done at the transaction level, at the company level. For example, specific venture capitalist firms would be putting money in specific companies, and they have to make an investment decision. Do we invest or do we not invest in a specific company? So we wanted to get down to that transaction level of analysis to try to understand what is driving this decision, and why aren't more venture capitalists looking to what you would think would be very high growth, albeit risky, opportunities in Latin America. So venture capitalists are somewhat specialized in understanding risk and managing uncertainty and putting a lot of money to work behind entrepreneurs for great potential. And there must be companies like that all over the world. So why were they not really investing that much in Latin America? Well, in 2005, we kind of began looking at the transactions themselves. So we started gathering the data, and there are some pretty decent data sets out there of venture capital, mostly in emergent or already developed countries, but they did have data on some developing countries too. So we started to look at that, and we pieced together a database of about 500 transactions in Latin America across 13 countries and over a 9-year period. So there was a pretty good sample to take a look at, what was going on in these countries. So of course that included Brazil, Chile, Argentina, Panama, Costa Rica, Mexico, Colombia, Ecuador, Guatemala. Most of the countries down there had some activity going on. So we had a data set of 13 countries and 500 transactions, over this 9-year period. So we thought, okay, this will be a great way to test this. So we started analyzing the data, and we started to see the real differences between venture capital investing in Latin America versus venture capital investing in the United States. So since the 1970s, venture capital has been developing in the United States. So it's a very well developed market here. It's very efficient. There are some large firms that have been doing it for a long time. A huge amount of it is in Silicon Valley, also in the Boston area, in Research Triangle, in lots of the hot spots for high technology growth companies. Now in Latin America, it's all spread around across different kinds of companies, because there isn't such a high tech sector, which really was part of the question. Why isn't venture capital sort of co-developing with a technology sector in Latin America? Well, what we were able to analyze through the kinds of statistical and econometric models that we can use was that there's a big difference between the institutional environments in these countries. Maybe that's kind of obvious, but we tried to get behind, open up the hood and get into the black box and understand across all these different countries and at these different times, how were the institutional environments in these countries affecting venture capital investment. And we found something very, very interesting. One, which most people would have guessed, and which there was some evidence of already, is that the political risk, the political hazards in a country reduces the size of the transaction. So for example, if I'm interested in investing into a high growth company that I find, say in Brazil or Argentina, and normally I might put $5 or $10 million into that company, if I see a high political risk or a high political hazard that something might go wrong in that environment, where I would lose my investment, then maybe I'm not going to put as much money there. Maybe I'll test the waters. Maybe I'll put in $2 million instead of $5. So we found that on average across all these investments, in the countries and at the times when there was higher political risk, higher political hazards, we called it, that the size of the investments would be much lower.
Before we go on,
Yeah.
can you explain what you mean, what your team means by political hazards or political system?
Yeah. It had, the measurements we used were from existing measures that are out there through the World Bank and other kinds of sources. And generally what you're looking at is the consolidation of power. So for example, in the United States, we all know we have a balance of power, we have a judicial system, we have a Congress, we have a president who's elected by the people. And so the ability for a company to prosper independently without being disrupted by the political environment is part of what we're trying to get at. A good example could be a country like Venezuela, where many years ago it was a fairly attractive place for investment, but in more recent years, because of the political regime changes there, it's been perceived as a much riskier place for foreigners to put money into Venezuela. There have been a number of times when the government there has nationalized certain industries, nationalized certain companies. So can you imagine putting $10 million in to finance a telecommunications infrastructure company, and the government decides, oh, we'd like to own that now, and so we will kind of take that. These things do happen in certain countries. So that the political risk in Venezuela changed fairly dramatically, and predictably you can see that there's really not much venture capital going on at all there anymore. Whereas Colombia, on the other hand, has become a more safer place to do business and so forth. And a lot of that ties into the political regime and how the different levels of government are operating. So that's some examples. Now, so that's on the one hand, we looked at political hazards and political risks. But on the other side, we looked at the quality of the legal system. And a lot of times when you look at analyses of this nature, scholars will lump together all of these factors. But we decided it was important to break out the legal system quality from the political risk. And that was very important because in venture capital, one of the most important things are the contracts. So I'm going to make an investment in a company. I usually won't own majority control of that company. So I'm a minority investor in a company. I might own, as a venture capitalist firm, 10 or 20 or 30% of a company. Well, if that company runs into trouble, what's going to happen to my investment? What kind of control do I have? What kind of rights do I have? If there's intellectual property in the company, like patents, what's the patent law in that country? If I put $10 million into developing some technology and inventions and so forth, can I patent that and protect that? Or is that likely to be taken from me and I may not have any recourse? Similarly, what happens if the company has to file bankruptcy? What happens to my investment? What happens when we create supplier agreements or other investment agreements? What kind of terms are allowed? But most of all, it's how are those contracts protected? If there is a problem, can I go to court and easily solve that problem with an understood legal system? How do I navigate that legal system and so forth? So because in some countries the legal system quality, you could say, is not very high or robust, then what really happens is there's more uncertainty. So for venture capitalists, their job is really balancing the risk versus the return of the investment. If the uncertainty around that investment is higher, the risk is higher. It's simply, do I feel comfortable putting $5 or $10 million into a company when I don't know what will happen in a court of law if the founder leaves, if the banks try to take over the business, if someone doesn't deliver the equipment that I purchased. So when we say legal system quality, we're really meaning the ability to enforce contracts and the ability to have some clarity about how these contracts can be dealt with. There's one quick good example I'll give. We found some prior research about an investment that was made in, I think it was Peru, and because of these questions around the legal system, the investors decided that they needed to own more than 50% of the company. So they weren't comfortable owning 10 or 20 or 30% of the company like a normal venture capital investment might represent. They had to put in even more money because they had to make sure that they could control the company because there was so much uncertainty around the laws. So this is one of the findings that we had that was actually counterintuitive. So, opposite from the political hazards finding, where we found that when there's greater political hazards, you invest less money into each transaction, we found out that when on average the legal system quality was worse, you actually put in more money.
Interesting.
So, and the problem with that is, okay, the legal system is worse, there's more uncertainty, so in order to make myself feel comfortable in that business, I might have to put in even more money. That makes me just not want to invest at all. Or I have to sit back and wait until the company is big enough and successful enough that I'm comfortable putting in those larger dollars. So the real finding was that venture capital as we know it in the United States breaks down in these countries that don't have a high enough quality of legal system and a low enough political risk. There are some countries that have achieved that, like Brazil, Chile, Argentina, where you see the legal system quality is fairly high, the political risk fairly low, and you see venture capital happening, and you see it becoming an actual institution in those countries, whereas in some of the other countries they're just not there yet. So,
do you see any kind of differences in the types of companies that are emerging out of these countries based on the differences in their political and legal systems?
Yeah, definitely. Because venture capital type money is not, really able to be attracted around certain high-risk ventures, you actually do see a lot of the kinds of ventures that you would consider to be lower risk. So whereas in the United States, most of the venture capital money is going into technology startups, a lot of R&D based type companies with real technology and breakthrough innovation. In emerging economies, you see venture capital type money still going into more like infrastructure type companies, manufacturing type companies, even retail, real estate. So you can see that there are hard assets there. So to lower the risk, if there are actual hard assets there, as opposed to just knowledge-based assets, the investors have a little bit more confidence in putting that in place. As well as those countries are still emerging, so they need infrastructure investments, they need manufacturing, they need retail. So there's a real interdependence there. I mean, there's a chicken and an egg problem where until you have those basic infrastructures in place, it's hard to set up a research lab and fund the next pharmaceutical company, for example. So venture capital is much more tailored towards high growth, typically higher technology type ventures where you're not seeing a lot of that emerging yet from Latin America, but there's a chicken and egg problem. You need the capital or you can't have the companies, and you need the companies or you won't attract the capital. So it's starting to slowly happen. One thing we saw was with Brazil. Brazil seems to have broken through kind of a hurdle, you could say, or a barrier of capital from within Brazil going into Brazilian venture capital. So in a sense, Brazil has now developed their own venture capital industry within the country, whereas most of the other countries in Latin America are still very highly dependent on U.S. capital or Western, industrialized nations and capital coming in from Europe and so forth. So each country needs to get to a level where the political systems are robust, the legal systems are robust, the uncertainty is lower, and the economy is bigger and so forth, and then the venture capital dollars will start to flow, and venture capitalists will actually emerge within their own countries and those firms, and they can be less reliant on foreign money coming in.